Hey everyone, and welcome to today's Explainer. We're jumping right into a really powerful step-by-step guide we found on how to stop losing your hard-earned purchasing power and start building real, actionable wealth. If you're a beginner looking for practical steps to actually grow your finances, you are in the right place. We're going to break down the math behind your money and show you how to position it so it's actually working for you.
Here's our agenda for today. We'll start with the hidden wealth destroyer, then move into Step 1, small business partnerships, Step 2, income-generating real estate, Step 3, the gold standard, Step 4, dividend stock returns, and finally, your financial action plan. Let's get to it.
Starting with Section 1, the hidden wealth destroyer, why safe savings are an illusion.
So we're all taught from a really young age that the absolute safest place for our money is just sitting perfectly still in a traditional bank account, right? But imagine you park 100,000 taka in the bank, and after a year, it actually feels like it's only worth 80,000 taka. I know that sounds completely crazy, especially when you look at your bank statement and it still clearly says 100,000. But the reality of what your money can actually do out in the real world is shrinking right before your eyes.
To really wrap our heads around this, we have to talk about purchasing power. Basically, this is the actual real-world value of your money, measured by the quantity of goods or services it can buy at any given time. So while the numeric amount in your bank account stays exactly the same, its actual value, what you can physically toss into your grocery cart, is literally being destroyed.
The brutal math here is absolutely wild. Over the past 10 years, average inflation has been running at about 8 to 10% per year. Meanwhile, traditional savings accounts, they've only been paying around 4 to 6% interest. So mathematically, this means your money has been losing its value at a rate of about 2 to 3% every single year. The bank tells you your money is totally safe, but this invisible tax of inflation is completely outpacing your interest.
Let's put this into perspective and see how it builds over a decade. Think back to 2016. Let's say 1,000 taka buys you a specific basket of groceries. Fast forward 10 years to 2026, and those exact same groceries now cost about 1,800 to 2,000 taka. That's an 80 to 100% jump in prices. Now, if you locked away 100,000 taka fixed deposit in 2016 at 5 to 6% interest, today it's grown to about 160,000 to 170,000 taka. It looks like a gain, but because prices rose way faster than you're interested, you haven't actually made money. You've lost purchasing power.
Which brings us to this incredibly revealing insight. Wealthy people use banks for transactions, not for long-term saving. The wealthy completely understand the math we just went through. They know that leaving large chunks of cash sitting idle is a guaranteed loss, so they use entirely different strategies to actually store and grow their wealth. So that begs the ultimate question, doesn't it? If the bank is naturally destroying our purchasing power over time, how do we actually grow it? Well, it's time to pivot from the harsh reality of inflation into our actionable guide. We're going to walk through 4 highly practical steps, especially great for beginners, to beat inflation and start building.
Step 1. Small business partnerships. Profitable business models.
A lot of people falsely assume that getting into business means you have to take on terrifying risks and build something from scratch. But look at these annual returns. You've got your standard bank interest at 5 to 6%. On the far right, healthy small online shops or local businesses are operating at a 20 to 25% annual profit margin. By just becoming a profit-sharing partner in a business run by a friend, colleague, or local entrepreneur, you could secure a 10% return on your investment. That easily crushes the bank's rate. And just like the big investors do, you can spread your money across several small businesses to lower your risk.
Moving on to Step 2, income-generating real estate, physical assets that outpace inflation.
This step is all about acquiring physical assets that historically just run right past inflation. The advantages here are so compelling. Property values have surged by about 15% per year over the last decade. And if you manage to grab a commercial space or an apartment, you're capturing substantial rental income on top of that. Those returns absolutely dwarf bank interest. But hey, what if you're a beginner and you just don't have the cash for prime commercial real estate? The play here is to buy accessible land in less expensive areas, maybe near your town or village. That land steadily appreciates over time and almost always beats out a savings account.
Step 3. The gold standard. The ultimate liquid safety net.
So why gold? Well, it acts like a currency, and its price rarely collapses, even when the broader markets are having a meltdown. But the real secret weapon of gold is its extreme liquidity. Imagine you stumble across a dirt-cheap plot of land, or a friend offers you a brilliant partnership in a local business, but all your money is locked up in fixed deposits. You'd have to agonizingly watch the deal pass you by. Selling gold gives you instant funds to seize that opportunity, anywhere, whether you're in the city or a village. It's one of the very few assets you can convert to cash rapidly and reliably.
Step 4. Dividend stock returns. Earning reliable yields in the market.
For beginners who are willing to learn the ropes, navigating the stock market is a huge way to make your money work. Just look at this comparison for a standard 100,000 taka investment. If you leave it in bank savings, you're only generating 4,000 to 6,000 taka a year. And as we've already established, that doesn't even cover inflation. But if you carefully select reliable dividend-paying companies, they often yield roughly 10 to 12% per year. That exact same 100,000 taka is now generating 12,000 taka annually. You are literally doubling your return simply by repositioning your capital.
All right, let's pull it all together. Your financial action plan.
Smart money doesn't just sit in one place. Instead of leaving massive, vulnerable sums in the bank to slowly wither away, smart investors spread their money into a diversified portfolio. They allocate capital into small business shares to grab those high profit margins, real estate and land for physical appreciation, gold reserves for extreme liquidity, and dividend stocks for reliable market yields. This balance makes sure you're protected from inflation while keeping cash accessible the second you need it. So, a quick recap of our step-by-step guide. Step 1, find profitable local businesses to partner in. Step 2, buy accessible real estate or land. Step 3, hold gold as a highly liquid safety net. And Step 4, learn to invest in high-yielding dividend stocks. That is your structured path from being a passive saver to an active, diversified investor. If you take away just one thing from this explainer today, make it this. Stop leaving big sums in the bank. Seriously, stop letting the invisible tax of inflation steadily eat away at the purchasing power of your hard-earned cash.
Which leaves us with one final, absolutely crucial question for you to chew on. Where will your money sleep tonight? Is it going to sleep in a bank account slowly shrinking in value? Or will it be deployed into businesses, land, gold, and stocks, waking up tomorrow ready to work for you? The math is clear, the practical steps are laid out, and the choice is entirely yours. Thanks so much for joining me on this explainer, and I can't wait to dive into our next topic together.